So today I would like to talk about a great benefit that small business owners can use. And it's not a benefit that's for the rank and file. It's for the benefit of the owners and the key executives to reward those people who are driving the value of the business up and in the management. And also those people, the higher earnings, who really are discriminated on a lot of the regulated plans like 401k and profit sharing. So it's a way of carving out a better benefit so when they retire, they have more of their percentage of a benefit to their earnings. So I am going to go over this program, and having so many years in practice, I can tell you that it's one of the best benefits I've ever installed and used. And it's not just one thing, it's a combination of many things that you can use in the executive compensation. That's why we call it a CEEP. So here we are, the CEEP, the Corporate Equity or Executive Equity Plan, which is a benefit for high paid and owners of companies. So what is a CEEP? Well, a CEEP is a method of financing the purchases of life insurance policies. Why? Because as you'll see as we go down the track, the life insurance contract can be an ideal tax-effective method of providing a benefit. The CEEP plans are really in an agreement between the employer and the employee to share the costs of the life insurance policy. And it's a flexible benefit for your employees. And you'll see in a moment all the things that you can do with it. It's very unique for the owner and the owner's family also. And it's the way, as I always talk about, shifting wealth from the cash flow of the business out of the business to the sidelines where the owner of the company owns it, out of the peril and risks of having too much equity in your company. So what are the shared elements? Well, the elements of the plan, which are typically split between the employer and the employee, are ownership, which is optional in some of the plans. Sometimes the employer owns it, sometimes the employee owns it, sometimes it's a split. The cash value, that's the money growing in the plan. The beneficiaries are split. Employers will always get back what they've been putting in, and the premium is split. And that agreement is made up in the beginning. It certainly can be changed, but that's the four areas of programming the plan itself. Now, there are some plans that give full ownership to that participant, and we'll talk about that. So why a CEEP? Well, there's a lot of reasons, but let's take a look at it. You can select your own participants. You're not limited. You don't have to include everybody, but you can handpick the people in your business that you want to give a reward to, or you want to have a vested program to keep them. You know, having a key man stay with you is priceless, really, but you can't really do that with a 401k or some qualified plan because they can take it with them. So you want a plan that has some vesting. Selecting participants also could be family members that work in the business or yourself. You can participate in the plan. You could add money to it as an individual along with the employer. It does attract and retain employees, especially in the key group where these people are used to high income and high benefits. So it's a plan that you can pick one or two people out that you want to treat special, and you can devise a program around that. It's established without IRS approval. Everything we use has been set in stone with the IRS. We don't have to get a private letter ruling or anything like that. You control the cash value. That's really key. Most of these plans, the employer, who's making the lion's share of the contribution, will control the cash value until such time as the program is set to change hands. And when that happens, the employer is going to either recover their premiums, deduct it, or a combination of the both. And it is, like I put down here, it's a real low risk involving and providing the funds to pay for insurance protection, very inexpensive. So the benefits to the employee are low cost life insurance, policy cash value for retirement, income tax-free death benefits to the family. 401ks are nice, but what happens if you die 10 years into the plan and your goal was to create $1 million? Well, you know what? Your beneficiary is only going to get what was in that plan. But with these plans, you can set in motion, if you don't complete your savings, what the family is going to get tax-free. How about opportunity to take over the policy at retirement or even earlier, depending on the contract? It's also with the CEEP program, employees and the employer have the right to go in and pull out money tax-free with no 10% penalty pre-59 rule. And it's a very low out-of-pocket cost. Today, with the long-term federal adjusted rate at 1%, an employer can make a contribution of $30,000 and you're only going to have $300 imputed in your income to pay tax on. Very cheap. So there's a lot of ways to split the premium. Let's talk about the premium. How is the premium divided? Well, you can have the employer pay all. There can be a contributory plan, or you can make bonuses to the employee, take the tax deduction to fund their part of it. The cost to the employee is usually the tax on the imputed income or the economic benefit, which is the measurement of the death benefit or the measurement of the loan interest. Employees share the premium, can be contributory, or again, can be bonus. What does the employer recover? The entire premium that they've put in, the employer share of the premium that they've contributed, or they can take a large tax deduction when the time comes where the plan's going to end and the employee is going to take over. By the way, the employee could be you, the owner. So let's talk about the non-equity CEEP. This is really all about having a death benefit for the employee. And the employee pays an annual cost of term that's imputed. The employer owns all the cash. The employer gets the share of the death benefit greater of the total premiums paid of the cash value, and the employee gets the death benefit. When the plan ends, the employer will recover all the money. This is where we have an employee that wants a good death benefit, but that doesn't mean you can't turn this non-equity program into an equity plan. But you also have an equity CEEP, we call it, where the employee is subject to a collateral assignment. They are imputed some income costs, like if it was a $30,000 contribution, that employee would have to pay the taxes on $300 that year. So in a 30% tax bracket, it cost them $90 to be in the program. The employee owns cash value exceeding the employer's contribution. So later down the track, when this policy mushrooms into huge amounts of dollars, the employee basically can take over the excess over and above the employer's contribution. The employer will always get whatever they've paid in premium until the policy and the plan is ended, and the employee gets the balance of that death benefit. So if you had $1 million death benefit and there was a death 10 years before retirement, the employer gets what they put in, but the employee's family gets the rest tax-free. Cost recovery when the plan ends, or the tax deduction when the plan ends. Depends on the plan and how we formulated it. So here's how it kind of looks. During the employee's lifetime, the employer will pay premiums to the insurance company. The employee will pay an income tax or economic benefit imputed to their income, and there's going to be an agreement between the employee and the employer. The employer is paying the premium. The employer could choose to bonus or sell the policy to the employee at retirement. And the employee has insurance is purchased. The business pays for most of all the premium. The employee pays the balance, if any, or the imputed income. The employee typically recognizes income annually or can take tax-free income out and create a family bank. And again, that's a great thing to have. You have a family bank growing with oodles of money to be able to take out tax-free. So how does it work at the employee's death? The same thing, employers paying the premium. At death, the insurance company takes the death benefit, pays back to the employer what they've put into the plan, and the balance of the money will go back to the beneficiary and fulfill the retirement dreams of the family. How about business owners, the taxes? Well, it's a non-deductible premium because you're going to be able to keep the asset on your books as a cost recovery asset. So if you put $10,000 in and the cash value is $10,000, you get to put that on your book as an asset. You still have a lien against that, but you don't get the deduction. The deduction, however, can come later when you decide, if you decide, to bonus it to the employee at retirement. The tax-free return of premium or cash value when the plan ends, tax deduction for the bonus of cash value to the employee. So the employee retires and you say, well, you know, I've put in this kind of money, I'm going to give it to you, we'll take the deduction and you're going to impute it a tax. Well, maybe the tax is big, but guess what? The employee now has accessibility to that big pot of money that they can take out tax-free to pay the tax liability. So it's not out of the employee's pocket, it's out of the policy that was funded by the employer. Not a bad deal. And when you look at the numbers, they're phenomenal. Even when I use low rate assumptions at 3, 4, 5%, the plan will outperform most investments. I can tell you that when you put together the tax leveraging and the effectiveness. So we're using and funding life insurance through the CEEP program, which provides a tax-free cost recovery for the business owners and fully tax deductible of the business. You know, everybody wants a tax deduction. Think of the amount of money you put into your 401k for your employees. You get a nice tax deduction, don't you? But you know what? Even if you get a 21% on the corporate and federal level and another 5 or 6 on the state level. So you deduct out of $100,000, you get to deduct $26,000. Guess what? It costs you the difference out of your pocket. With a CEEP program, you own everything. You get it back. And I'm not saying replace your 401k and profit sharing with a CEEP. I'm just saying when you're thinking about spending more money in benefits for you and your key people, a CEEP really makes a lot of sense, much more than a cash balance plan or some of these other plans where you can get a deduction. So the taxes to the employee on the non-equity, it's always going to be the taxes, income, the term insurance value, or the death benefit. And any cash received is taxed as income, meaning cash value. The equity plan, where the employee does recognize imputed income very low and can take advantage of tax advantage retirement in a cash flow form by tax-free dollars. So when you're doing good planning, employee heirs can receive those policy proceeds tax-free. And again, we do talk about that as a great benefit. So the advantage of the business owner is the fact that you can, business owners can participate in a plan for himself and his family, key people. It's very appropriate for a C corporation taxpayer. Typically, full bonus structure CEEP is more appropriate for owners of pass-through entities, but it all depends on income and where you are in a tax bracket. It's something we do talk about. Advantages, company dollars are being used. Your company checkbook could do more for you than your own personal checkbook. It's a great strategy when the company tax bracket is low and the owner's personal bracket is high. Estate tax management, where appropriate means basically we don't have to keep the death benefits in the estate, especially with the unified credit changing and coming down. We're really shifting corporate dollars to create wealth outside the business with tax efficiency. I've always said for many, many years, employers put too much wealth in their business. So when it collapses or there's an economic downturn, they can't get it out. So take some of those cash flows, use it effectively, and build some wealth outside the business to help support your family, your financial security, and maybe the business, as the business finds itself running into financial problems. And you can discriminate in favor of highly paid people and the owners of the company. That's really big because in 401ks and profit sharings, it's the higher paid people that really get discriminated. Think about it. When you take Social Security and the amount that a typical person could put into a 401k, their level of income when they retire in relationship to their last 5 years is going to be much higher than the higher paid executive because they're limited on how much they can put into the profit sharing plan. Value benefits. To summarize, it can provide the key employees and owners with income protection. Death benefits are tax-free. Supplemental retirement income can be tax-free payouts. Tax-free access before 59 and a half, like a family bank. Tax-deferred growth. Safety of the assets in the plan can be designed with contribution flexibility in mind. Shift business cash flow to the owner's wealth outside the business. That's big. Other business applications could be key person insurance, supplemental executive retirement programs, buy and sell funding, personal estate plan needs. So to implement the plan, you need a CEEP agreement with the attorney. You apply for life insurance and you designate the beneficiary and the collateral assignment. You take steps today to provide these benefits. They're very good. So I want to thank you for taking the time to spend with me on this. If you have any questions, you can contact me, email me, and I'd be more than happy to send you backup information. Thank you very much.